On a weekend in January 2008, one of the largest banks in Europe found a hole in its balance sheet so large it looked fictional. A junior trader had built a hidden position worth 50 billion euros. 50 billion. More than Société Générale was worth on the stock market. By Monday, the bank faced a choice: confess that it had lost control, or unload everything in secret and hope nobody noticed. It chose secrecy. 3 days later, 4.9 billion euros were gone, and the world got a clean explanation. A rogue trader. One bad apple. One man who fooled a modern bank. That is the version banks love, because it makes the system look innocent. This is the story of the phantom trade. It starts far from Paris. Jérôme Kerviel grew up in Pont-l'Abbé, a small town in Brittany. His father was a blacksmith. His mother was a hairdresser. He was not supposed to become the face of a global scandal. When he joined Société Générale, he did not start as a star trader. He started in the back office, the hidden machinery, the place where trades get checked, reconciled, rejected, or quietly waved through. That mattered, because most traders only learn how to place bets. Kerviel learned how the bank looked for mistakes. He saw which controls were real, which ones were theater, and which ones could be satisfied with the right paperwork at the right moment. In 2005, he moved to the Delta One desk. On paper, this was supposed to be boring. Low-margin index futures, hedge trades, tiny edges, minimal drama. But that is where the mystery begins. How do you hide an illegal market bet inside a bank built to detect illegal market bets? Not with genius code, not with some impossible hack, with a fake mirror. Kerviel would enter a real trade, then create a false offsetting trade to make the book look balanced. A phantom hedge, a counterparty that was missing, temporary, or simply not real in the way the system assumed it was. To a computer, the risk appeared canceled. To the bank, the position appeared controlled. It wasn't controlled. It was disguised. And because he came from the back office, he understood timing. When to delete, when to replace, when to explain, when an alarm would escalate, and when it would die in someone's inbox. For a while, it worked so well that the scheme became self-protecting. At one point, Kerviel's hidden book reportedly showed 1.4 billion euros in profit. 1.4 billion. A junior trader was suddenly generating numbers so large that nobody wanted to ask the question behind them. Where is this money coming from? That is the part people miss. Profit is the best camouflage in finance. When the number is green, red flags start looking administrative. Warnings become paperwork. Controls become ritual. Later, Kerviel claimed the bank looked away because he was making money. The bank claimed it had been deceived by a loan manipulator. Both claims can be true at the same time. That is what makes the story dangerous. By January 2008, the hidden exposure had swollen to roughly 50 billion euros. Not because the bank approved it, but because its control system kept accepting a reality that wasn't real. Then, the market turned violent, and now the bank had a problem much bigger than Kerviel. If it admitted the position publicly, confidence could collapse. If it held the position, losses could deepen. If it dumped everything, it could save itself by injecting panic into a market that was already cracking. This is where the official story becomes too neat, because the catastrophe was not only the hidden trade, it was the decision that followed. Over 3 days, Société Générale unwound the entire position into a falling market. Fast, quietly, at scale. Traders watching the tape did not know they were looking at one bank trying to amputate its own mistake. They just saw size, urgency, fear, and fear spreads. When the selling stopped, Société Générale had lost 4.9 billion euros. At the time, it was the largest trading loss ever pinned on a single person. So Kerviel became the monster in the headline, the rogue trader, the blacksmith's son who outsmarted a giant institution. But if the institution was so sophisticated, why were there so many missed signals before the collapse? Why did fake hedges survive repeated checks? Why did extraordinary profit not trigger extraordinary scrutiny? Why did the system only become intolerant of risk after the trade stopped making money? That is the uncomfortable truth. Kerviel did not break into the vault. He grew up inside it. He used ordinary systems, ordinary approvals, ordinary human incentives. He did not need the bank to be blind. He only needed it to be busy, hierarchical, and addicted to good numbers. That is a much more frightening story than rogue genius. Because it means the weakness was structural, and if you think that weakness belongs to 2008, look around. In 2026, the hidden risk is less likely to sit on one guy's desk with fake tickets and more likely to hide inside automated execution, synthetic exposure, off-book assumptions, and models nobody fully understands. The interface changed. The temptation did not. If the numbers look good, do not ask too many questions. If the position is profitable, let it run. If the dashboard is green, trust the dashboard. That was the culture that made Jerome Kerviel possible. He was not the whole scandal, he was the audit trail. And the next phantom trade will not begin with a dramatic confession. It will begin with a green dashboard and a room full of people deciding not to ask the second question. Subscribe if you want more stories about the hidden failures inside modern finance. And if you want to see what happens when the human rogue trader disappears and the machine goes rogue instead, click the video on your screen for Night Capital.